Welcome back, everybody, to We Are TPM with myself, Kyle Teixeira, sitting next to this dude right here, John Teixeira. Once again, we are back this week to discuss listening to the market. So you're going to listen to us discuss listening to the market. If you would like to listen to us in a different format, like a phone call, give us a call, 817-818-9039. Shoot us an email at showmethemoney at wearetpm.com. John, what markets are we listening to? Are you the whisperer? Are we listening to the market whisperer? Or what's this topic about? Tell the people.
Tell the people. What market are we listening to? We could be listening to like the flea market or the grocery market, or what market are we talking about? We're talking about the rental market, right? Because that's what we do. We're property managers, and we watch people make emotional decisions about the pricing of their homes all the time, right? Mm-hmm. And when we're in the type of market that we're in, where some neighborhoods are flat, some neighborhoods are going down, some neighborhoods are going up, but at a much slower rate than they were before, it creates a scenario where homeowners need to make different decisions. And if they're not listening to the market, what do they get? They get DOM, right? Days on market.
They get vacancy. They get, I'll make the argument, they ultimately get lower rents if you're not responsive to what you hear while listening, right?
Yep.
So why are we talking about this? John has had this, we've had this conversation or a question a lot. This conversation from questions a lot.
Every single month.
Every single day owners in this market. Because why? Because as renewals come up, as things get released to tenants, there's scenarios where maybe the next tenant's paying less than the previous tenant, or the same amount, or the renewals are not going up, or we've been through a 5-year period where people were used to the opposite of these things.
I just realized selfishly the reason why we're doing this podcast right now is so that I don't have to have this conversation every single month. I could just send this to my owners every single month. Just listen to this podcast before you ask me all the questions that I know you're going to ask me.
Well, now they got to get through that comment before they hear the content. So you just screwed that all up. So sorry to everybody.
Now they know it was intentional. Everything's intentional. I love it.
So it's not just listening; it's listening and responding.
Yeah.
What's the conversation? What's the answer? Let's line it out for the people. What are you telling people?
Let's start with the reason why people question, right? So first and foremost, let's say we propose a rental price. Somebody's paying $2,500 a month, and we're proposing to have them sign another 1-year lease at the same price and not raise their rent. Why are we doing that? My taxes have gone up. My insurance has gone up 25%. I get that all the time, which is very true. I spent more on repairs this year than I expected or wanted to, yada, yada, right? The homeowners are feeling the pain, and it's legitimate pain, right? Why can't we raise our rents to help us make up the pain at renewal time? That's the obvious question. And the reason is because if you have a good tenant, you don't want to push them out of the house down the street and end up with a vacancy, right? If somebody down the street is marketing their home for $23, $24, $20, the same price you're at, $2,500, and you raise their price to $2,600, $2,700 to help make up a deficit that you're now having, you potentially are pushing them out of that home, because the first thing they're going to do is go on Zillow and go, oh, hey, honey, we can stay here for $2,700 a month, or there's a home down the street for $2,500 just like this one. Let's just move down there and save a couple $100 a month. Now, not everybody's going to do that for $200 a month. I get it, but it's still a possibility. Why would you even put yourself in that position?
The easy answer is there's, we've talked about this a lot in a lot of different ways, but there's no correlation between your costs and what someone will pay to rent the asset that you own.
You have to listen to the market.
Yeah, it's not the market's fault. You have a mortgage. You could have paid cash for it. You could have done all these things, right? You can change those metrics, but at the end of the day, listening to the market's important to getting money for your investment, regardless. Getting some kind of money, because it's an easy thing to think of monthly cost, right? But costs are really daily. they're hourly, they're minutely, and if you look at it as a daily cost, that can almost change your whole perspective on everything. What am I getting per day? Because every day it sits on the market, that goes down.
Every day it's vacant,
every day it's sitting
right?
vacant, that goes down. What are you getting annually on a daily basis? Well, every day that is not rented for that year, your annual basis goes down. And that's a perspective that I try to talk to people about, but it sounds confusing, right? You put it there, so then you chop it up into the 12 months. Well, I need $3,000 of rent. I'm like, well, everybody in your neighborhood's renting at $2,800 right now, so you're not going to get $3,000. So if you sit stubbornly at $3,000 for a month, for 2 months, what did you not collect? You didn't collect the $2,800 for 2 months. What's that? That's $5,600 that you didn't make, and that makes up for a lot more than $200 difference on monthly rent.
Yeah, and even if in your example you did get lucky and found somebody to rent for $3,000, but you sat there for 2 months trying to do it, your point is the same. Okay, I finally got $3,000 like I wanted because I was being stubborn, but it sat around for 60 days at $250 a day cost, right? That's probably about...
Let's put it in a simpler term, because I had someone tell me that this was a simpler way to put it the other day. 2 months versus renting it out today at $2,800, right? $2,800 times 12 is $33,600.
All right, over the course of a lease, I'm going to make $33,600.
If you waited 2 months, then you only got 10 months. That's $30,000 at $3,000 a month. So that 2 months of stubbornness cost you, in this scenario, $3,500, $33,600. Didn't make it simple, did it?
Oh, you only took into account lost rent. Yeah, so that's a good
Potential
perspective.
rent.
So
Yeah.
that's a lost rent, but that's only one part of your vacancy rate, right? One part of your vacancy rate is your lost rent, but your mortgage, your taxes, your maintenance, all the things that go into owning that home adds to it and probably doubles that amount, really, realistically. So, you know what I was sitting here thinking?
What?
If we change directions just a little bit. You know when nobody complained about... So here's what I'm thinking.
I know what you're going to say.
The market ebbs and flows. It goes up and down and does all this stuff. So everyone's complaining that the the market right now, that everything's going up, taxes are going up, insurance is going up, like I described, right?
What went up first? What led those things?
Yeah,
rent rates.
That's okay. You're making. I think you're asking a question to make a point that I'm about to make, and that is nobody complained when it was the opposite and interest rates were going down. Everything was level. Everybody was making a lot of money, and rental rates were skyrocketing year over year over year for 8 years. It kept going.
Really,
Boom,
since
boom,
2017.
boom. Every single year we're doing renewals and another 100, another $200, another $150. I mean,
I wouldn't say nobody complained. The tenants definitely complained. The market definitely complained.
I'm referring to owners.
Supply and demand.
So my point is, if you have a short period of time right now that it hurts for some reason, try to not be forgetful of the period of time before that it not only didn't hurt, but it was a really great wealth building time. And if you didn't prepare for the downturn like you should, piling all that stuff into an account and letting it pile up so that
Or buy stuff.
Or buy something else. Yeah.
Like we say it's saying we use in stocks, but it's buy the dips and enjoy the rips, enjoy it, and when it goes down, buy stuff. So
it's easy to complain when things are painful.
Well, let's talk about the dynamics of why we're talking about this and why it's so important to be responsive when listening to the market. So at a high level, I just brought stocks into it, right? So if the stock price starts going down, do you want to be the guy that sells when it starts going down or when it finishes going down, right? You want to be the guy that sells near that top once you see the writing on the wall. Well, if you're in, let's keep this micro, if you're in a neighborhood and there's 10 listings on the market and there's only 6 renters looking in that market, right? Your 6 of those units, there's a demand for 6 of those units and there's a supply of 10. Okay.
Mm-hmm.
Well, if you think you need your 3,000, you think your unit's worth 3,000, which at the end of the day, things are worth what people will pay for them. And you stay at 3,000 and everyone else in your neighborhood stays at 2,900 and say there's 4 people that stay at 2,850. What's going to happen?
The 4 people at 2,850 are going to get rented.
They're going to go in a minute, and then,
And then you got 2 more out of the remaining 6 that are going to go. So you better have something special.
Yeah. Yeah. And now
you better have something special with your property that's better than the rest of them. Condition, updates, whatever it is. A great patio, a pool, something has to be different for yours to get chosen, or you have to have some luck.
And we're not in a market where people are paying a big premium for those amenities, right? Yeah. They're actually because they're being forced to downsize in a lot of scenarios because these rates have gone up. You have to look at the perspective of the people, your consumer. So why is that so important? Well, you want to make sure to get quickly starting out or get to in this example that 2,800, even if, because you know what you will do if you in that exact scenario, if you're at 2,775, you're going to be the first one to lease. Yeah, you may have cut $25 off the amount, but
you also cut 10 or 15 or 20 days off of your vacancy rate.
Exactly. And this is how market perspectives works when things start getting difficult and people start competing with price drops. Well, this moment price drops become a competing factor, you want to get ahead of that, right? Because now you could lock into a lease at a lower amount than you wanted to because you were late to the game. You were late to the ball game. So you also paid for vacancy and you're likely going to rent for a lower amount. Not just listening to the market, listening to your property manager is probably the best advice.
Yeah. Can I present a pretty realistic scenario that I have seen over and over again while I'm doing comps for properties? So you're looking at a neighborhood, right? So what do we look at? We look for comparable homes that have leased, right? That are just like mine. What are they leasing for? And then we're also looking at what our competition is. Okay. It's kind of a twofold process. Well, I have seen over and over again where people have done what you just described and they've been somewhat stubborn. They went on the market. They got a great price. That I actually think that this home is worth that price and will someday be back at that price. We're just at a weird time in the market. So let's use your example. I see homes that have recently leased within the past 90 days for $3,000, just like my home, same neighborhood. That tells me I could do it again, right? But it took them a long time to do it, and I have 2 or 3 homes on the market at the 2,800 like you described. That scenario is a real scenario that I see. I just did 10 homes this month. I did 16 homes we did for renewals, and I would say about half of them actually had that or a very similar scenario when I pulled it up. And so I'm forced now to compete with these ones that are on the market, right? When I'm going out on the market or sending my renewal, because I don't want to be this guy down here, right? That's maybe getting the 3,000 but vacant, or losing a tenant and having turnover costs, or I'm sitting for 58 days. That's your point, and I'm just trying to demonstrate that is we're not just making this up. That is an actual real scenario that I am seeing every single day.
And everyone's seeing. I'd say that we recently went to a conference of property managers, and this was across the nation. People are seeing this at varying degrees, some more extreme. I'd say varying degrees in maybe the more extreme scenario for some other markets. But the baseline right now is pretty much what we're describing. I mean, we're in a market that isn't seeing the extreme variations of this, but markets change quickly, and generally when they go downward, they generally move quicker than when they go upward.
So what do? We're talking about listening to the market. So you listen to the market by making a great analysis, right? And you try to come out with a great price. But what if you miss it? What if you miss the market, or the market shifts on you while you're doing that and something happens? What are we going to do about that?
I'm a big math guy, as everybody on this that listens to this knows. I always try to say it's better to get ahead of it than be in line with it, right? Like, so in that exact scenario, I would feel very comfortable at 27.75. Why? Because I know I'm getting picked. I know I'm getting leased quick. I know I'm getting at least the market value for it. And some might call that a discount. Well, no, because you're signing a 1-year lease. So what's the market going to look like in a year? If it does continue down, what are they going to compare their lease rate to? Did my 20 days I saved really, really help me? You know, I'm getting out of an uncertain market as quickly as possible, in and out, you know? And that's not just conservative. It's just, you know, makes sense.
So what if you go out on the market at 2,800, 27.75 and nothing happens?
Well, we'll have that exact conversation scenario I just described, and someone will hear me out and then say, all right, well, let's go 29.50. So I guess the first thing I'd say is just don't do that.
But what if they insist on it? You're going to go on the market at 29.50. You know,
they're going to spend 30.
We're serving our clients even if they don't listen to us. What are we doing?
Probably getting blamed after 45 days when it sits vacant.
No. What are we doing? What kind of action are we going to take? What are we going to do from that point on? We're gonna go on the market at 29.50, and when it doesn't get the activity that it needs to get, meaning we're not getting shown, and we're not getting applicants to review, right? That's kind of your baseline telltale sign that we are priced too high, whether an owner believes the market or not, or what they get. I mean, that's just the baseline. I've been on the market for 7 days, and I've had one showing with feedback that the price is too high. That's like, where you're clearly way too high. First thing I'm doing is I'm dropping that price $50 every week until that activity becomes regular showings and we're getting some applications to review.
Yeah, and I think the perspective of landlords needs to be more important to the fact that tenants, like a lot of landlords will say, we set the price, right? You know, we set the market. Well, no, the people paying usually set the market, whether it's sellers or buyers market, no matter what the market is. If there are no buyers, sellers do not set the price.
That's right. We set the price based on their activity.
Yeah, if there's way too many more buyers than sellers, then then you can set some prices, but they're still not going to pay. There's still a number they won't pay, right? But the whole, how do they know comparative, like, you have to remember that people looking for a rental, or really looking in any market, are doing an active comparison, not just the way realtors doing it, or like, they're actively looking at properties. They're like, I want to live in this neighborhood, I'm going to go look at all 10 in my scenario.
Right.
Or they're going to go they're going to cut out the top 2. They're going to go look at the 2800s and the 29s to see why they're 29, realize it's not worth the extra money, and then book, you know. That's what they're doing in person for their actual lives, right?
And if you're an owner, here's all you have to do is change your perspective. Stop thinking like an owner for a moment and put yourself in their shoes, and go on Zillow, Realtor.com. What's the latest one? Homes.com is making a big push. Go on your favorite real estate portal site and put in homes for rent in whatever your zip code is that your home is in, and pretend that you're the one looking for a home to rent. Which one would you go? Which ones would you go see? Which ones would you consider putting an application in on if you were them?
Well, and if you think that these websites that you're talking about don't have an incentive to show you the ones that make metric sense to them first, they do. They're going to see, okay, well, these 3,000 ones, we're kicking down to page 5, 6, 7. We're kicking them way down because they're getting low views. I can see on the back end that there's these other houses in this neighborhood for cheaper, and that's what the consumer wants. That's what we're going to give them.
Everybody's clicking on this one and viewing the photos in the description, so it's going to get shown more, right? So to your point, those $3,000 a month ones aren't even getting clicked because there's a bunch for 25 to 2,800 that we're clicking on and looking at pictures on. They're getting more activity, so their algorithm is going to put them higher on the list. We also put it higher on the list because, we pay for that, but that doesn't work. For most rentals, 9 out of 10 don't have people like
So we're
us.
sticking to the same scenario. We're stubborn, $2,950. We wait. It takes us a month to get it, and we somehow get it for them. All right. Well, now we got $2,950 locked in. You're looking at, in the same scenario I was talking about before, we were at 33.6, right? If you had the 12 months at 2,800, well, 11 months at 2,950 is 32.45. So you still cost yourself
$32,450
on the annualized basis. You still cost yourself $1,200.
Man, we have such a good producer back there doing math for us and everything. This is great. I love this. I wish you guys could see this behind the scenes.
And that's still conservative. We're just annualizing it. In my eyes, it's still 30 days that you didn't get $2,800.
Yeah.
So.
And this is only taking into account lost rent again. Y'all, I can't remind you more that this number is actually double. Really. I mean, you could literally double these numbers.
No, I wouldn't say you double them, but because you pay some of the holding costs regardless.
That's my point. Whatever. The vacancy rate, your rate of vacancy is what it is. So, and it includes your holding costs. So I got it what you're saying, but the point is that's what you're losing. You're losing $2,950 if you wait a month in your scenario, right? You just lost $3,000 basically.
Well, and when the 12 months comes up and you have a tenant sitting at $2,800, so in my eyes, you made more money because you got a lease quicker. Now you got a renewal coming up at $2,800. Tenants comparing their $2,800 renewal to the market, or you have the $2,950 tenant who's now comparing their $2,950 to the market. That's going to have a different effect on the tenant's actions and your actions likely at the renewal time. So $2,950 sounds great. What's your likelihood of renewing that for 2 years, for 3 years, for 4 years? Because in reality, in order for that to make up for that month you didn't get, your break even is a few years down the road. I mean, in that scenario, 28 to 2950, you're probably a year and a half, 2 years. So if you don't get that second renewal, now you got another vacancy for it. It can snowball over time. Like, obviously, we don't have a crystal ball. You can never look in hindsight. But what you can do is put a higher weight on that vacancy time. Well, okay, I could have done this still at 2850, but I didn't risk the 30 days, the 60 days. So.
Mm-hmm. Yeah, I don't know. So I guess the point being, listen to the market, right? Price it right, so you don't lose money, because you'll make more money if you just price it right to begin with. And if you price it wrong, it's okay. Adjust it. Make regular price adjustments. Listen to the market. Make regular price adjustments. Hey, we've had the market in some neighborhoods shift on us so quickly that we have sat on the market for 30, 40 days sometimes in rare cases, but we didn't sit there and sit on a price. We made constant adjustments, and sometimes we even get into a point where we start doing incentives, right? Like move-in incentives. It's cheaper to pay people to take some money off of their move-in costs and help them get into a home, especially some of these lower priced homes, right? Than it is to have it sitting vacant for the same reasons that you're doing the math here. So, the market shifts, it ebbs and flows. And when it's going good, and we don't have to do any of this stuff. And we got all kinds of applications to look at, and that's all great. And then when it gets a little bit tougher like this, you got to work at it. You got to be smart, and you got to do some math like we're doing here.
Yeah, like how much rental income do you want by December 31st? If you ask it that way, well, I want this amount of money. Well, at $2,800, if we lease it tomorrow, I can get you that. At $2,900, if we lease it in a month, I won't get you that. And that's what they're going to be talking to their accountant about. That's what they're going to be looking at a cash flow statement in January about. So, perspective is everything. So don't just listen to the market. Keep your eyes on it, right?
No, and I remind people, if you're not making enough today, you're not breaking even, making a profit on a monthly basis today. That's today. That's not always going to be that way. You will at some point. That will change. Absolutely 100% in the future. That will change. Will it get worse before it gets better? Will it stay the same for X amount of months or years? We don't have crystal balls for those things, but I can tell you that you will come out of that situation and you will not always be in that situation.
It's because the government will keep printing money, right?
That's
the only assurance we have in life.
One factor in it all, yeah.
Inflation is guaranteed.
Or they'll keep mining crypto or something. I don't know. It's probably the direction.
There's at least a limit to that, but we won't get into that. If you guys have any questions about listening to the market, want to listen to us talk about listening to the market outside of this format, give us a call, 818-818-9039. Shoot us an email at showmethemoney@wearetpm.com, and we are out.
Don't stop listening.